Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So the community is growing. We have so many people that have joined the channel for in the last few months, and so many have joined in the Patreon account. I'm getting loads of requests and emails and all sorts of things, which is absolutely amazing because this is what we wanted. This is basically where we wanted people to be, inshallah, and so we can actually all share our journeys and so on. And a lot of the questions comes from, the brothers and sisters who have either been investing for quite some time and they have lost a lot of money because they invested in companies that were speculative, companies that were not making any profits and lost quite a bit of money. Some have put their money into crypto. We've even got, alhamdulillah, one brother who's done really well with crypto, but now he's like, do you know what? I want to go away from that and invest in this money into something real, something tangible, an asset that's tangible. And he said, I can't buy property with it yet, but I can actually put it into the stock market. How do I go about it, and what do we do, and how do you look for high quality businesses that I can invest for the long term? And this has been quite one of the questions that people have asked me over the last few months. So what I'm going to do now is just share with you guys give you like a breakdown of what makes a high quality stock, and especially for long-term halal investors. And I'm just genuinely mean that long-term, meaning 5+ years. We don't talk about buying stock today and selling it tomorrow. Sometimes your thesis might change, things might not work out. You can sell a stock for that reason. But generally, what we're trying to do is find high quality businesses that you can hold for a very, very long time. And then at the end, I'm going to show you an example of it. So I'm going to show you some of the things to look for. And then I'm going to show you two examples, two different companies. So the things that we're looking for today are four main things. We're looking for financials of the company. So how good is the company? Is the revenue growing? Is the EPS growing? Is return on investment capital and return on equity and things like that? What do they look like in terms of this company? We want to see if they pay dividend, consistent dividend growth. We want to see if the company has moat, which is basically a company that has a basically wide economic moat, meaning they have a long, basically lasting competitive edge, for example. Okay, so things like basically the pricing power, brand dominance, and network effect, or regulatory advantage, and so on. And then finally, we will look at the valuation of these companies. Okay, so that's exactly what we're going to do. So I don't want to make the video any longer than it needs to be, so I'm going to get into it straight away. So as an example, I'm going to use Visa for my good example, and I will use this to show you some of the things to look for. So for example, within the financials, what are we looking for? So that's exactly what we're going to do now. So Visa is this company here. Visa is a Sharia compliant company. They own the technology behind the cards that you use. They don't deal with the cards themselves. They don't actually charge you anything. They don't care about that. They charge the company. They basically get their money from the company. And what they do is they facilitate from that transaction going from A to B, okay, making sure the security side is done, it goes to the right person, and so on. So whenever you go to a shop and you buy a product, the owner of that shop will receive their money and so on, and the company, the basic Visa, will charge the owner fee for that transaction and making sure that they get their transaction. So they're not dealing with the river side of things. So, and I've said this a million times, so please try to understand that, because of course when you are new to every video that I do and I mention video and Visa, someone says something about it. So that's basically what they are. Visa and MasterCard are very, very similar. Okay, so that's the first one. Now what I'm going to look for now is the financials. Okay, and I'm going to use simply save dividend because of the graphs, and so how much basically it makes things easier. So first thing I'm looking at is the market cap. So I can see the market cap is huge. They've got some dividends here, and then credit rating is something also important, but we're not going to focus on these things. What I'm going to go straight down to is the EPS growth, because that's the bit that I'm interested in. Earnings per share is basically how the company makes, how the company makes money. So it says here, adjusted earnings are used to exclude noisy one-time events such as non-cash basic impairment charges. The best businesses will steadily increase their earnings their earnings power over time to help fuel dividend growth and appreciate basically in their stock prices. So from basically in 2015, the company was making $2.62. You want to see this going up every single year. 2020 was a slight drop, but then we came back up because of COVID. Things went up again and it's heading in the right direction. So it is really important that you find companies that have a basically growing earnings. So that's the first one. The second one is basically sales or revenue, if you like. You also want to see this head in the right direction, okay? Because remember, the revenue is the company that the money the company makes from selling their goods and products, right? Products and services and so on, okay? And basically, you want to this growing every single year. If you are basically investing long-term investor, you also want to see if the shares outstanding and things like that are declining. Return on equity, return on invested capital, and operating margins, free cash flow margins, all of this will help you understand if this business is managed really well. So return on equity, for example, measures how many dollars of profit company earns for every dollar shareholder have invested in the firm. Okay, and that's as simple as that. Okay, so Warren Buffett normally tends to favor firms with a consistent mid-teen returns, basically, which indicate they could possess an economic moat above 10% is basically what these people are looking for. 51% for Visa. So it's really important. Return on investor capital, on the other hand, is the measure of management's capital allocation skills, meaning the money they get it from us, what are they doing with it? Okay, the money they get as a basically profit, are they reinvesting back into the business? Okay, so the firm's metric divide, basically that tells you how it works. It says an advantaged firm typically earns stable and above average return over time, which is basically what we're looking for, 31%. So return on equity and return on invested capital both are important. And the next one is the operating margins. Sometimes we just we overlook this, but it's also important. A measure of the profitability that divides operating income, what is left after the company deducted its cost and goods sold, basically sold and operating expenses, by total sales. Higher, more stable operating margins can be a sign of basically advantage business. So a company that has a moat, for example. So this one is consistent. Okay, is consistency is basically what you're looking for, and growing consistently, that's what you want. Free cash flow margin, again, is important. The free cash flow margin is measure is the amount of cash a company generates after paying basically all of its expenses and investing into to maintain and basically expand the business. Basically, is divided they take the free cash flow and divide it by the sales, basically, which is this part here, which is basically what we've seen here, the sales part. So all of these things are important and simple things that you can look for. And for me, the most important ones are earnings per share, sales growth or revenue growth, for example. And you can use websites like, for example, Seeking Alpha. If you go to financials, and then you basically in here where you got the income statement, you can see the revenue. You can see from $13.8 billion to right now $37.8 billion. You can see how much they spend to make that money. You can see what is left, which is the gross profit. Okay, you can see how much they're spending on things like basically research and development and so on. Then you can see the net income after all of that is done, how much of that money is left, how much of this $37 billion is left basically after that. So that's almost to $20 billion. The other thing you also should be looking for the EPS. As you can see from there to here, you can see the basic EPS and also balance sheet. The other thing is that's really important. I will basically advise people to look for is the total liabilities against total assets. Okay, so not the current ones. So total liabilities, we've got $58 billion. So let's call it $55 billion against how much the company owns. So we've got, where's the total assets? There we go. $92.8 billion of total assets. So that's whatever everything the company owns against how much liabilities they have. It's really important to know these things. And the other thing that you also need to pay attention, so that's just the financials. The other thing you need to pay attention to is the moat of the company. And like I said, if the company has a wide moat, Warren Buffett basically always talk about this, and it's important because it could be the fact that company earns the moat by pricing power, if you like, brand dominance and network effects or regulatory advantage. So for those companies where they have a patent, for example, drug companies, so you can get basically all sorts of ways when it comes to the moat side of things. But look for companies that have a wide moat, and do a bit more research on that. Go on basically Morningstar Valuation and you will find out. I did a video actually, I talked about, I think 3 weeks ago. Watch that video to basically see what basically wide moat means basically. Okay, and then the other thing that's important to me as a dividend investor or dividend growth investor is this idea of buying high quality businesses that pay excellent dividends. So this one is basically the yield is small, but we don't really care about that. We wanted the safety to be 99% or higher. You can find here as well. They have a different basically ways of dealing with these things. So this one here, for example, dividend safety gives the A+ for this company. As you can see, the 5-year average and all of that stuff. But I use both of them. Okay. The payout ratio, make sure it's as low as it can be, because this is the amount of money they will be spending out of the net income to pay out as a dividend. So the lower the better. Okay, now the latest increase is okay, but the 5-year and the 10-year is what I'm interested. The 5 years, I want this to be at least 7% or higher. So this is 15 foot, basically 0.4%. And that's what you want to see, that you want to see that this consistency of growing this dividend. So you look for dividend kings, dividend aristocrats, but that are still growing. Okay, so 16 years without basically without reducing that, which is really, really good. It doesn't matter how much they're paying right now. It doesn't matter how much, what the yield is right now, is that consistency. That's what matters to me. And the final thing is the most important thing, and that is basically this whole idea of valuation. Okay, it's important to buy companies when they're actually trading below their intrinsic values, and you can use all sorts of websites. I like to use Morningstar Valuations. I also like to basically started using this basically recently, and this is basically fast graph. It is a bit expensive, but of course it is quite helpful. So this one, if I bought it right now, for example, it tells me Visa is overvalued. If I use the normal PE for this company, it tells me I will be making about 10% per annum moving forward. If you use basically what Wall Street is basically saying right now, Wall Street is basically saying it is actually buy right now. As you can see, they've got 23 people saying it's a strong buy, 9 buys, and so on, and they saying it's about 6% upside from where we are, $382 per share. But remember, they basically get the average from all these analysts and they put it together and they give you an average. Okay, I'll prefer this because this looks at the intrinsic value of the business based on the growth side of things, basically what we're expecting. And that's basically what also Morningstar does. They use the discounted cash flow model to come up with this, not average it out sort of a thing. So that's valuation matters, and it matters a lot. And the reason I said that is because if you buy a high company when it's actually trading below this intrinsic value, look at this one here, Visa. I've got it in my portfolio, right? I only have 20 shares, but I'm actually up almost to £2,000. I bought it, I believe I bought it when it was actually below this intrinsic value, because my average is $221. Okay, right now we're looking about $357 per share. So it is important to buy these companies when they're trading below their intrinsic values. Okay, and final one I want to show you guys is basically this company called Boeing. Okay, I want to share with you and show you what Boeing is like. In fact, I'm going to use this to show you what Boeing is like. So this is the comparison to what we've already seen. So it's a huge company, 163 billion market cap. It has a basically moderate strong when it comes to credit rating and so on. They don't have any dividends, which I was actually surprised. But look at this. Earnings per share is been absolutely disgusting. Look at this. Free cash flow, same thing. Look, shares outstanding, up and down, up and down. Okay, total sales has been declining since 2018. They had a little bit of recovery in 2023, then they've gone back again. Okay, look at return on invested capital. Look at return on basically return on equity, operating margins, for the free cash flow margins, okay, and they have a quite a bit of a debt as well. So you can see, I don't even have to show you and explain to you. Look at this one as well here. When you look at the historically, when you max it out, you can see this, the earnings growth. Look at that, declining, going up and down, up and down. The very, very cyclical business. And I wouldn't touch it. I really wouldn't touch a company like this. And this is why it's important to look into what you're buying and make sure you know what you're buying. Don't just blindly buy the stock because someone else has said it looks amazing. Even sometimes I'll talk about stocks that are probably not great for you anyway, because your age and your time horizon and my time horizon might be different. I might be buying Cummins, for example, but you might want to buy, I don't know, AMD, Nvidia, because you feel like, you know what, I don't need that dividends, I don't want a stable whatever. I'm 23, I want to buy companies that will be the next best companies out there by the time this guy's age. Okay, so do what you need to do and think about the long term. And inshallah, I hope this sort of a video helps, because all I'm trying to do is help the community, inshallah, in the long run. So if you found this video any helpful, please hit that like button, subscribe to the channel. Let me know if you have any questions, inshallah. And if I'm gonna do more deep dives into like halal stocks and invest in the Sharia compliance side of things. So yeah, share it with your family and friends, and also let me know what's on your watch list. I want to know exactly what you're buying, what you're selling, and so on. So yeah, have a wonderful day. Assalamu Alaikum.